Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your February 2021 Market Update. Well, what a difference a crisis makes. Over the last few months, there has been a significant shift in sentiment toward greater government spending, with the majority of Americans believing that massive fiscal stimulus is still needed to overcome the negative economic consequences of the pandemic. Janet Yellen, shown here, the U.S. Treasury Secretary, has promoted this idea of going big or going home by recently stating that the price of doing something too little is higher than the price of doing something too big. So one of the things garnering headlines during the month of February was the plan to pass a sweeping fiscal package worth $1.9 trillion to provide additional relief during the pandemic, with a second package focused on recovery and infrastructure to come later. The sheer amount of spending has caused some concerns, particularly around inflation, which caused a market pullback right at the end of the month. And I want to take some time to talk to you about this today. To give you a picture of how our economy is doing since the COVID-19 induced recession, the chart here on the left shows economic growth in the US. And although we've had a quick V-shaped bounce back, you can see that growth is not increasing as quickly as it was. And we are still a long way from trendline growth, which is the dotted blue line there. And then the chart on the right shows jobs lost during the COVID pandemic and what percentage of those jobs have been recovered. Some sectors, such as leisure and hospitality, have a long way to full recovery, which is why getting the pandemic under control is key to getting the economy back to normal. In a recessionary environment, the government uses either monetary or fiscal policy to get the economy back on a good growth trajectory and to reduce unemployment. And you may recall that monetary policy is controlled by the central bank through interest rates, whereas fiscal policy is controlled by the president and Congress. And you typically do want to see the government increasing spending during a recessionary environment in order to boost the economy and reduce unemployment. And commonly, fiscal policy actions are done in one of three ways: through tax cuts for businesses or individuals, which gives people and corporations more money, which may make them more likely to buy things, increasing demand. They can also enact fiscal policy through establishing new government jobs, which increases demand for labor, lowering the unemployment rate, and also through automatic fiscal policies, which kick in right away, such as unemployment insurance. Now, the U.S. has already passed $3.5 trillion in legislation to combat COVID-19, and you may be wondering how this proposed additional spending compares to what other countries have done to combat the effects of the pandemic. This chart shows the response to the pandemic for various developed countries as a percentage of gross domestic product. As a reminder, gross domestic product, or GDP, is the total value of how much we produce in a year. So think of this chart as how much we have spent on the COVID-19 fiscal pandemic response as a percentage of what the U.S. typically makes in a year through production. The U.S. is listed at the top of this chart. And while we may have sticker shock at the cost of a new $1.9 trillion bill that's currently working its way through Congress, so far we actually haven't spent as much money as other developed countries to combat the pandemic as a percentage of GDP, because the dotted area shown there is what is expected to pass by mid-March. So if this $1.9 trillion pass, our fiscal response will then be ahead of many other developed countries, but still behind the UK, Germany, and Italy. While the fiscal response was massive, what matters even more than government spending on COVID-19 is the accumulation of debt over time. This chart shows the federal net debt to GDP ratio, and it's a simple way of comparing a nation's output to its debt levels. In other words, the ratio tells you how much money the country earns each year compared to how much it owes. And as you can see from this chart, our debt has been steadily increasing since the mid-2000s. The last three U.S. Presidents Trump, Obama, and Bush, are the three presidents who have run the largest budget deficits in U.S. history. So while the COVID pandemic has exacerbated the debt issues over the last year, the trend of accumulated deficits comprising a bigger percentage of our output has been in place for some time. With U.S. federal debt now at 100% of GDP as of the end of 2020, which is the highest since World War II and projected to continue rising, investors have been wondering, what is the breaking point of mounting U.S. debt? So to give you a picture of that, some economists argue that debt to GDP over 75 to 80% is worrisome. However, others argue that the debt to GDP ratio isn't always a great predictor of whether a country will default on its debt. For example, Japan has had a debt to GDP ratio of over 100% since the mid 1990s and has been running at over 200% since 2010 without defaulting. So what exactly should we do with this type of data and trying to understand how much is too much and when will this become an issue for the United States? Well, the critical consideration to examine is not actually the level of debt or the ratio of debt to GDP, but rather the cost of servicing the debt. The chart on the left here shows national debt soaring, which is the gray line, but the interest rate paid on that debt coming down sharply in recent decades, the light blue line. This has made debt more affordable, which is one of the reasons why Congress is comfortable at this juncture in passing more of a relief package. The chart on the right shows the cost of servicing the debt as a share of GDP. So despite the surge in government debt to combat the effects of the pandemic, given the low interest rate environment, the cost to service this debt, the solid blue line, is much cheaper than it has been in the past. So for example, if you go back to the mid 1990s where that chart spikes there, the cost of servicing debt rose to 3% of GDP. And that's the level that forced President George H.W. Bush to renege on his promise of no new taxes. Using current forecasts from the Congressional Budget Office, interest payments on all of this debt that the U.S. is taking on would appear to be manageable throughout the next decade. However, the forecast also suggests that interest rates remain low. If the average interest rate instead rises to 3%, which is shown there by the upper dotted line on the right-hand chart, the current debt level would be more problematic. So overall, as long as interest rates stay low, the debt appears to be manageable. But what does this mean for you as an investor? Well, down the road, if the cost to service debt becomes too high, deficits and debt would have to be tackled through spending cuts or tax increases. And this would slow economic growth and the value of the US dollar would likely decline. As the US dollar declines, imports become more expensive, which contributes to inflation. And we've had some clients asking us questions as of late as to how to hedge a rise in inflation. In fact, rising rates and inflation is what spooked markets right at the end of February, as you saw both the bond and the stock market sell off a bit in the last 2 to 3 trading days of the month. One thing to remember is that the light point portfolios which you're invested in are globally diversified. And we have a lot of tools in our toolbox to manage both a rising rate environment and an inflationary environment. While some asset classes will suffer in an inflationary environment, we actively manage this risk on your behalf. And there are many asset classes that we are already accessing in our portfolios to help hedge both of those issues, interest rates and or inflation. So I just want you to take heart that we're on this. We are already managing this within your portfolios. And if it appears that the debt servicing cost is likely to increase through increases in rates over the next couple of years, we will proactively adjust the portfolios accordingly. So let's take a look then at asset class returns year to date. Starting from the left, domestic large cap stocks are up 1.72%. Small cap stocks have really rallied. They're up 11.58% year to date. International developed market stocks, which are stocks in countries such as Japan, Germany, and France, they're up 1.15%. Emerging markets was up 3.85%, and that's an asset class that we've been overweighting for several months now. Domestic bonds have had a rough start to this year. The domestic bond index, the light blue bar there, is down 2.96%, but we have been underweighting this asset class in favor of some alternative investments in order to reduce the risk from rising interest rates there. And then on the right-hand side of the chart here, commodities, which includes things like oil, agriculture, and precious metals, are up 9.27% year to date. And finally, gold, which I'm featuring this month because we've been getting a lot of questions on the precious metal, is down 9.28% year to date, despite inflationary concerns. So there have been many videos circulating on the internet about gold, given concerns with our nation's debt and inflation. And I hope I address some of these debt concerns in the video. But if you've been wondering about gold in particular, it's important to know within this asset class, people often mistake very long-term performance for short-term protection. And if you strip out the 1970s oil price shock inflationary period, gold actually has little correlation to inflation. And that's because when inflation rises, central banks tend to increase interest rates to combat inflation. And when that occurs, holding an asset like gold, which pays no dividends, is not as valuable as holding onto an asset that does pay dividends. And that's one of the reasons why gold is one of the worst performing asset classes year to date, despite the inflationary concerns that investors currently have in the market. So in terms of gold itself, just to wrap up this part of the conversation here, there are many more asset classes that you can access to hedge a rise in inflation without taking on the level of risk or tax issues that you court when investing in gold. And we are actively managing those inflationary type hedges within the portfolios on your behalf. As always, we thank you for your continued confidence, and please reach out to us with any questions that you may have.